Hi everybody, welcome to another update on the stock screener. Today we're going to look at the oil sector because I think that we're at a point where rig counts are dropping and oil production could go negative. So I want to see which oil company is the best to buy, meaning high leverage, high margins, and low valuation. So low enterprise value to free cash flow. So I have looked at some oil companies, but I can't look at all of them, of course. So I picked 9 of them. So the first one is Arc Resources. Large cap, market cap of 12 billion, enterprise value 16 billion. At current prices, it has free cash flow of 1 billion. So that's 14 EV to free cash flow. Leverage, when you up the prices of gas condensate, natural gas liquids, then you get a leverage of 1.5. So if oil goes up 10%, then this will go up 15%. So there's a bit of leverage, not that much. So do I want to buy this? I don't think so, because EV to free cash flow is 15, which is overvalued. So this is the enterprise value, and the valuation is half of it. So there is a downside risk. I think there are better companies than this one. But yeah, it's a very big company with a lot of good assets. So maybe there is growth in the future. I think they can increase production 10% per year, probably. Arrow Exploration, not bad at 80 oil. It's fair value. So yeah, this is a nice company, 75% oil. Gear Energy, small cap with 300 million market cap. Leverage is also the same, 1.6. EV to free cash flow 10, so this is cheaper. Share price has gone down. But still, I wouldn't buy this because the EV to free cash flow is 10. So there is some downside risk. This is the enterprise value, and there's a risk to drop another 20-30% if oil stays flat. So I wouldn't buy this either. The leverage is not that great, 1.6. So no. Next one, Hemisphere Energy. Also small cap, 150 million enterprise value. Also the leverage is just 1.6. This is cheaper. Enterprise value to free cash flow is 8. So this is one of the cheaper companies. I think this will start to bottom out here. This is good value. Would I buy it? Not sure. I would buy it at 5 times free cash flow, actually. So this is still too overvalued for me. There's maybe 20% downside. You can also see production is dropping to 2,800. It was at 3,000. So this company has lower production, which is probably the reason why it went down. In play oil, they had a lot of oil, but now it's only 43%. So something is going wrong with this company. It has more and more gas. 350 million enterprise value, mid cap. It has good leverage to the oil price. EV to free cash flow is also good, but yeah, production is going down, I think. 9,000 to 8,000, and it's becoming more gassy, which is not good. But anyway, it is fair value. I think it's fair value, EV to free cash flow of 9, but I wouldn't buy it. Kelt Exploration, that's more a gas company, only 20% oil. But look at the free cash flow, it's 0. So they have a lot of capex. They're not going to give you dividends because they don't have any free cash flow. It's a large cap, 1 billion to 1.5 billion enterprise value. Leverage is abysmal, only 1.1 leverage. I would never buy this company at this point. It's overvalued. But okay, it is a gas company, so if you think gas will go back to 5, then there is quite a lot of leverage. Nuvista Energy, 30% oil, so more a gas company. Leverage is 1.5, not spectacular, and EV to free cash flow is 20, so completely overvalued at enterprise value of 3.3 billion and only 160 million in free cash flow per year. So I would not buy this company because it's overvalued. Then you have Obsidian Energy. This one looks good because leverage is 4, very high leverage. EV to free cash flow is on the high side, 14. So yeah, it's overvalued. And very important, the break-even cost is 70. So if the oil price goes down just 10% from this level, then this company cannot make money. You can see that we are at 80 now, and if it goes to 70, then this company will make losses. So that's why I don't like this. It's high leverage, but also high risk. And we need to avoid companies with low margins. Stock price has also done nothing, has gone down. So not interested. Prairie Provident Resources just released Q2 earnings. They were very bad. Net losses, equity is still negative. What's the break even here? Break even is 80. So we are currently at the break even cost. So this company cannot make any money, and that's visible here. EV to free cash flow is 340. So very overvalued because they don't make any money. However, there is leverage of 5. So there's leverage to the upside if oil goes up. But even then, if we go to 100 oil, it's still overvalued because the enterprise value is around 300 million. Downside is still 50%, even at 100 oil. So buying Provident is a losing proposition. And you can see that here, this is never going to go up. Look at the debt, 200 million debt. Market cap only 80 million, so too much debt and no cash flow. Whitecap Resources is, I think, the best oil company out there. It has a very good break-even cost at 70, so that's good, and that's 70 CAD. Currently we are at 100 CAD, so plenty of downside protection. EV to free cash flow is 11, 12, which is acceptable for such a big company. It's 6 billion market cap and 10 billion enterprise value. And the leverage is also good, 2.5 leverage. So I think Whitecap is the best company, 75% oil as well. I like oil more than gas. So this is, I think, the winner. And that can be found from this chart. We pick companies with the lowest break-even costs, so we have high margins. Whitecap is in here. We pick companies with high leverage to oil. This is, high leverage, 2.5. And we pick cheap companies with a low enterprise value to free cash flow. That's one of the cheaper ones at 10. So Whitecap, then Hemisphere, and then in-play oil. Now comes the clue. Look at these charts, and now we get the following chart. What do you see here? I added a gold company to these oil companies. Soma Gold beats them all. Soma Gold has 6 times leverage to gold, and it has the lowest enterprise value to free cash flow of only 3. So very cheap, much cheaper than all these oil companies, and more leverage than all of these companies. So why should I sell Soma Gold to buy oil companies? I don't understand that. And if oil goes up, then gold will eventually also go up. They are correlated 1-to-1. Through history, gold and oil just follow each other. Okay, so why should I buy oil companies at a much worse multiples, while I can buy a gold company with much better multiples? And assuming, of course, gold and oil is the same. They just go up and down at the same time. Both are like commodities, so there's no reason to buy any of these oil companies. Just stay with Soma Gold. Just to show you that I'm not just making things up. So we have here the leverage, which is derived from the upside here based on the oil prices. EV to free cash flow, that's the EV, that's the free cash flow. So 11 and 2.4. And now we go to Soma Gold. Enterprise value is at 100 currently, 100 million CAD, as you can see here. And free cash flow for 2024 at 1900 gold is around 30 million. So that's a 3 times EV to free cash flow. Right? Using 45,000 production of gold and an all-in sustained cost of 900 with some capex 10 million, even deducted the taxes and interest of 4 million per year. So I'm not making things up. This company has an EV to free cash flow, as you can see here, EV to free cash flow of 3.5. And the leverage is this minus this, so that's up 25%, divided by the market cap times 4. So that's the leverage. So if gold goes up 50%, then this goes up 250%. So times 5 or times 6. If gold goes up 10%, Soma Gold will go up 60%. That's how you see this. And you can see that on this chart, if we go from 2000 to 2000, let's say 3000, that's 50% higher. Then the value goes from 100 to 250. So that's up 150, right? So from 100 to 100, from 100 to 250, because 100 plus 150 is 250. That's up 150%. So you can see the leverage 50% higher gives you around 250% upside, right? So there is plenty of leverage on Soma Gold compared to all of these oil producers. So that was the video. Just think about it. It's very nice to make comparisons between sectors. So don't look at one sector. Don't look at only the oil sector. You need to compare different sectors, oil and gold, with each other, and then you pick your companies. And I'll see you in the next video. Bye.